Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We featured several central bank governors on our show, from the Bank of England's Mervyn King to Reserve Bank of India's Raghu Rajan to Argentina's Alfonso Pratgay. And on this episode, we feature the current governor of the State Bank of Pakistan, Dr Reza Baqir. It's part of our goal to bring top policymakers as well as investors and researchers into our conversations. And I'm sure you will enjoy my wide-ranging discussion with him, which is relevant not only for followers of Pakistan, but also emerging market specialists too. But before I go into the conversation, I wanted to remind listeners to subscribe and rate our podcast show. This helps spread the word of the show and Macro Hive. Also, make sure to subscribe to our website, where you'll get a great range of macro analysis from views on Taiwan to whether MMT works. If you want more in-depth research, whether on capital flows to specific country coverage to global macro, drop me an email at bilal@macrohive.com and I can tell you more about what we can offer. Now, back to the governor. Dr Reza Baqir became the 20th governor of the Central Bank of Pakistan in May 2019. He took the helm as Pakistan started to embark on an ambitious reform program. Before that, he was an 18-year veteran of the IMF and previously also worked at the World Bank. He was the head of the IMF's office in Egypt and senior resident representative from 2017 to 2019. He also held positions as IMF Mission Chief for Romania and Bulgaria, Division Chief of the IMF's Debt Policy Division, and head of the IMF delegation to the Paris Club. His research has been published in top journals of the economics profession, including the Journal of Political Economy and the Quarterly Journal of Economics. On to our conversation. Welcome, Governor, to our podcast show. It's a great pleasure to have someone of your stature and your position to appear on our show.
Thank you, Bilal, for having me on your show, and I'm really looking forward to our conversation.
There's kind of a big focus on emerging markets these days, and a country like Pakistan is a fascinating country in itself. It's gone through lots of changes over the past year, and now we have COVID as well. So I thought maybe we could start with your perspective on how things were going in Pakistan before COVID, so 2019, as we went into COVID. What was the state of Pakistan from a macro perspective?
As you may be aware, Pakistan had found itself in a situation where two key macro imbalances were impairing its ability to achieve its potential in terms of growth, in terms of welfare, in terms of poverty reduction. And these two key challenges were a formidable current account deficit and a equally formidable fiscal deficit. These two areas led Pakistan to put together a reform program that was supported by the IMF, and formally it began in the middle of last year. Now, pre-COVID, as you know, in such programs, when there are significant external fiscal imbalances, there is a need for adjustment, and adjustment is usually difficult. In fact, if adjustment was not difficult for countries, it would not be delayed. So we started on that adjustment, and pre-COVID, we were beginning to see the results of our adjustment program. I told you that the two key culprits of our problems were the current account deficit and the fiscal deficit. So let me share you on the current account deficit. We had our monthly deficit on average reach a peak of around $2 billion per month. And that had reduced or fallen to about $200 million. So a reduction of tenfold into the deficit by December 2019. So that was a significant improvement in the current account deficit.
I mean, that's very significant improvement. I mean, what was the cause of that?
Many causes, but one of the key causes, Bilal, was an overvalued currency. And as you know, Pakistan historically had an exchange rate regime which was largely fixed. And we can talk a little bit later in this podcast about our transition from that fixed exchange rate system to a flexible market-based system, because that was one of the key institutional reforms or changes that underpinned our program that we started last year. And if you plot, Bilal, the real exchange rate with our export volume, not the values that you typically get from BOP statistics, but volumes, meaning deflating the export values with average export prices, you will see a striking relationship that as the real effective exchange rate begins to depreciate, our export volume begins to increase. We have shared that on our website as well as in different presentations. But one of the key reasons for the improvement in the current account deficit was the adjustment of the exchange rate. But the second key improvement, Bilal, was on the fiscal side, because that was the other key culprit. And if you look at our primary fiscal balance for the period July through March, and you will notice in steadily from fiscal year 16 onwards, this had been deteriorating. And this balance in last fiscal year 19, July through March, was around a deficit of slightly more than 1%. In fiscal year 20, our fiscal year starts in July. So July through March, our primary fiscal balance was actually a surplus. And so this progress on both the current account and the fiscal deficit was the key reason why markets are beginning to realize that the reform program that we had put in place was beginning to work. And it's the way it manifested, the way the market sentiment improved, it manifested itself in the stock market, first and foremost. And if you look pre-COVID, Pakistan's stock market was considered one of the best performing, if not the best performing stock markets by Bloomberg. It was also manifested, Bilal, in our reserves. And as you know from the experience of other emerging markets, once market participants begin to get an appreciation that a country is tackling its long-standing problems, capital and sentiment begins to improve. And our reserves began to improve very significantly. And we can talk a little bit more about that as well. And they increased in such a magnitude, Bilal, that even after the worst of COVID, we managed to end last fiscal year, which ended on 30th of June of this year, with a net reserve position that was considerably higher than we had started.
Yeah, that's really quite impressive. And, just for kind of context, in terms of the IMF program, obviously Pakistan has had a number of programs historically, and this is the latest version of it. Why do you think it was necessary to have a program?
I'll give a proximate answer, and I'll try to peel one more layer of the onion to give a more structural answer. A very proximate answer to your question, Bilal, is reserves. If you plot our reserves over a long period of time, and if you plot on the same chart those time periods when we have had an IMF supported program, you will see that the best predictor of whether Pakistan is going to have to go to the IMF is a fall in reserves or a very low level of reserves. And in our history, we have repeatedly, when faced with macroeconomic imbalances, the twin deficits, and in the context of a fixed exchange rate regime that was progressively becoming overvalued, and in the context of the great fear of exchange rate flexibility, reserve loss, primarily because of intervention in the foreign exchange market, has led us in the past to situations where we have not had enough reserve cover to meet our foreign exchange obligations. And at the same time, have also ended up doing step devaluations. So in the end, we used to have the worst of both worlds. The rupee also would lose its value, and we also would have lost reserves. It's a bit like trying to swim upstream in a river when you are trying to sell dollars to prevent a currency from depreciating if the underlying factors are structural. Now, I said I'll give approximate, and I'll try to peel one more layer of the onion. One of the key structural impediments to our external sustainability is a savings investment gap. If you compare our savings rate to other emerging markets, to countries in the region, you will see that we have a considerably lower savings rate. And as you know, a current account deficit, by definition, is the difference between a country's saving and investment rate. And in our history, because we do have investment needs, because we do not have enough domestic savings, we borrow. And that current account deficits lead eventually, in the context of fixed and overvalued exchange rates, lead to reserve loss and hence repeated IMF programs. We can talk a bit later also about why building reserves is extremely important, for us in the state bank, especially when we started our reform program last year. One of the key goals was to build reserves and build them steadily and significantly and maintain them such that we take away this uncertainty or perception of risk on the part of domestic and international investors that Pakistan will continue to have repeated balance of payments crises. And if we are able to successfully do that, and it remains a key focus of the State Bank of Pakistan right now, if we are able to successfully do that, I'm very confident that we'll be able to manage our macroeconomic problems ourselves.
Yeah. And Governor, I guess one unusual situation at the moment is that Pakistan has this IMF program. At the same time, Pakistan is borrowing from China as well. So you have two, you could say, large external lenders to Pakistan. How do you think about that dynamic?
First, Bilal, we've been transparent. If you look at the numbers that we published, including in the IMF staff reports, we transparently disclose how much we are borrowing from different countries. If we had something to hide, obviously, we would not be doing that. Second, I think it's important to realize, as we have also tried to communicate, we welcome friends, whether they are bilateral or they are multilateral. And we welcome friends in the sense who want to partner with us in meeting our development goals, and in that context, also providing us with financial assistance. So we welcome friends. Third, if we do have friends who have helped us, it's also incumbent upon us to appreciate their help as any country would. And it's not more complicated than that. Sometimes observers make this relationship out to be more than it is. But if you really boil it down to a few key, simple principles, facts, that's about all that there is to it.
Now, one interesting thing for you, I guess, has been that you became governor of the state bank sometime around the middle of last year, and you had a big challenge in terms of working with the context that we've talked about, the reforms and so on. Then COVID hit Pakistan and indeed the whole world. So obviously that's a big challenge as a central bank governor to have to contend with that. And, I guess, again, for context, what's been Pakistan's experience during COVID?
First point I want to make, Bilal, is that if we had not had a successful start to the IMF-supported program, and if we had not been able to successfully undertake stabilization measures, we would have been in a far weaker position to cope with COVID. And let me try to illustrate in what manner we have been able to provide some support and where we stand today in terms of our key vulnerability indicators. But before I do that, this stabilization that I was referring to earlier, that we achieved, say, from July of 2019 to March of 2020, would not have been possible without the ownership at the very highest level. The Prime Minister, Imran Khan, recognizing the depth of the problem and recognizing the need for adjustment, gave its economic policy managers the backing and the support to undertake these tough measures. And had he not stood fast and resolute in addressing those imbalances that are referred to earlier, on which there was measurable progress, had that not happened, Pakistan's experience in COVID today would have been a lot worse. It's a hard point to communicate, Bilal, because it entails the counterfactual. And as you know, in normal public discourse, particularly on the media, it's difficult to explain the concept of the counterfactual. But I can tell you from my experience in other countries, at the IMF, at the World Bank, in other contexts, that our situation today would have been a lot worse had it not been for what we had been able to achieve by way of adjustment. So let me illustrate that. As I mentioned, our fiscal year started on the 1st of July and ended on the 30th of June. in between, we got dealt with COVID. Let's talk about reserves. On our balance sheet, our gross reserves were 7.3 billion when we started the fiscal year, and they ended at 12.2 billion, about a 5 billion improvement. Now, this improvement, sometimes people wonder if it is due to increased foreign exchange borrowing on the part of the government, because when the government borrows, it deposits the FX counterpart in our reserves and gets the rupee counterpart. The key point is that none of this roughly 5 billion increase has to do with any change in net government borrowing. And by that, I mean that the reserve change due to government lending operations reflect both fresh disbursements as well as government's amortization and interest payments. The net of those two was about zero for the last fiscal year. So this improvement of about 5 billion in our gross reserves was not due to increased net government borrowing, because the government roughly repaid as much in debt service as it borrowed last fiscal year. So this was a high quality improvement in reserves. But more than that, Bilal, I want to draw your attention to the fact that the state bank also had a 8 billion short forward position through swaps and forwards, about 8 billion at the beginning of the fiscal year. And we ended the fiscal year with that forward position at 5.8. So an improvement of 2.2 in our forward liabilities, a reduction in our forward liabilities of 2.2 billion approximately. So together, these two factors mean that if you take our net reserve buffers, as in the gross reserves minus this short position, we've had an improvement of about $7.1, $7.2 billion despite COVID.
I mean, that's a very significant improvement.
We started off the year with about 7 billion on the books, and the net improvement in our foreign exchange reserves has been roughly the same, so nearly a double. And this improvement would have been even greater if we did not have COVID. So I was trying to answer your question that we went through COVID, we got a hammering like other countries did. I think it has been, in my experience of working in emerging markets, the mother of all external shocks that any emerging market has had to deal with. But we have come out of it with some core vulnerability indicators improved. And this was only made possible because of the difficult reforms we were undertaking before the onset of COVID. Now, the second key point I want to make, Vidal, is that our policy response in the context of COVID has been measured. Vulnerable emerging markets like Pakistan do not have the luxury of advanced economies, or for that matter, those emerging markets that entered COVID with much stronger fundamentals. And we don't have the luxury in the sense that if you have a high level of public debt, if you have a level of reserves, which, although they're improving, still are not as high in terms of import cover or other metrics of reserve adequacy compared to other countries, one has to be prudent and measured. Because if we are excessive in amount of the support we give and our macroeconomic indicators worsen considerably, then after the world moves beyond the current sympathy stage, if a vulnerable emerging market is left holding a bag with much deteriorated macroeconomic fundamentals and the sympathy factor in the international financial community has evaporated, you are left in a very difficult position. So we had to be very, very measured, both in terms of our fiscal support as well as in our monetary support. And we struck that balance. And today you will see that our number of cases and number of deaths have been coming down. Pakistan is the 5th largest country in the world. People sometimes don't remember, but our number of cases are much less and they have been coming down. And since this is first and foremost a public health crisis, and if we are able to maintain this improvement in the public health dimension, then we have reason to be optimistic about the future economic prospects. Another key factor is that, ironically, one of our structural weaknesses has mitigated the impact of COVID on our economy. And what I mean is our exports to GDP are much less than many other emerging markets and much less than where we would want them to be. And before COVID, economic policy managers of Pakistan, including myself, had been talking very actively about what we need to do to increase our exports. And we continue to work in that direction. But the fact that our exports were a smaller percentage of our total GDP compared to some other emerging markets has meant that the collapse in global trade and the collapse in demand from advanced economies has proportionally had a smaller impact on our GDP than has been the case in some other emerging markets, which were highly open. So today, when we look at the future, I'm quite confident, Bilal, one should never say never, but I'm quite confident that the worst in terms of the financial turmoil is behind us. I pointed to you how our reserve situation has improved despite everything that happened last fiscal year. We are now seeing our exports gradually beginning to recover. I think one area which we monitor carefully is remittances, because Pakistan is dependent on that. And if there is a sharp decline in that, that will pose challenges. So far, I have to say that we have not seen a very large decline in remittances. We've seen a modest impact, but that's an area that we continue to monitor. We remain undeterred in continuing our partnership with the international financial community. This dialogue is led by the IMF, but it also includes the World Bank, the Asian Development Bank, the AIIB, and others. And we intend to continue that to give the extra confidence and positive signaling that our reforms are also being backed by the international financial community.
I guess perhaps we can talk a bit more about the conduct of monetary policy and around the exchange rate regime. Now, I suppose historically Pakistan's followed more of a fixed exchange rate regime, which many other emerging market countries have. And I suppose the theory there is that if you anchor yourself around the fixed exchange rate, then you somehow import the credibility of the other side of the anchor, say the US. And so that provides an anchor of stability. Now, from what you've been talking about, that you want to move away from a fixed exchange rate towards a market-determined exchange rate, presumably then that means you need another anchor to ensure credibility, which presumably is the inflation anchor. So how do you think about that transition for a country like Pakistan, moving from an FX anchor to an inflation anchor, the transition from fixed exchange rate to a market-determined exchange rate?
That's a key part of the reforms that we undertook when we started the reform program in the middle of last year. Let me first just clarify one or two things. We undertook the transition from a fixed exchange rate to a market-based exchange rate in May of last year. Let me also make clear what I mean by a market-based exchange rate. It is not what typically people consider a free float, which I define as one where a central bank does not intervene at all. By a market-based exchange rate, we mean a rate that is primarily determined by supply and demand considerations, but that does leave us with room to intervene if we see there are disorderly market conditions. And in emerging markets that are beginning the transition from a fixed to a flexible exchange rate, that, in my view, is the right way to go about it, because if you have disorderly market conditions, they undermine the broader support in stakeholders, in the people, for recognizing the benefits of a flexible exchange rate system. Now, we undertook this transition back in May of last year. Prior to that, Bilal, if you look at our exchange rate, say against the dollar, you will see one-way movement. It would be held flat for long periods of time, like the heartbeat of a dead person. Then would come a period of pressure. You would see a step up and then flat, then again some pressure, and that's how it would be. One of the key differences in our exchange rate now versus how it was before is that you see two-way movement. And that was visible pre-COVID. That has also been the case post-COVID. The second key difference that you will see in our exchange rate is the intra-day movement in the exchange rate. Now, what do I mean by the intra-day movement? I mean the high-low in any given day. So if you take the most recent 100 days, from about the 5th of March to about the 5th of August, on average, the intraday range has been about 1 rupee. To be precise, it's been 0.97 rupees, but about 1 rupee between the range between the low and a high in the course of the trading day. In the 100 days before our transition, this intraday range was about 0.18. So 1/5 of what it is right now. Second, if you look at the average percent change in the exchange rate on a daily basis, and you take an average of that over some period. Again, if you look at the period from March till about August in Pakistan, the average absolute percentage change in the exchange rate has been about 0.3%. The similar calculation for Thailand is about 0.25, Philippines 0.27, Malaysia 0.29, India 0.35, Turkey about 0.5. So very similar to other countries which have primarily a market-based exchange rate system. So we have been able to make this transition from a fixed exchange rate to a market-based exchange rate. And we have also survived the test of COVID because, if you look at the experience of countries that have attempted to do such a transition, when they are struck by an external shock, there is a tendency to go back to what you were comfortable with, and that is a relatively fixed exchange rate. And you will see that for Pakistan, and we track this on a daily basis, we compare ourselves to a basket of similar emerging markets. And if you compare ourselves and you look from about the 20th of January, when we began to see, the pressure on other emerging market currencies, you see a range from about an appreciation of plus 7%, that's Serbia, I'm talking about the bilateral exchange rate with the dollar, to a fall or a depreciation of minus 21%, that's Brazil. Okay, so you have a range from plus 7 to minus 21. For Pakistan, this number is minus 8%. We've had a depreciation of our rupee of about 8% since January, which is pretty much smack in the middle of the range of emerging markets. And so what I'm trying to say is that despite the biggest test ever that could have come our way, we have managed to stick to the transition to a market-based exchange rate. And we see ourselves as in the middle of the pack of emerging markets, which we are very comfortable with. We would be, I think, more concerned if we were on either extreme. And I want to talk a little bit about some of the factors that we consider were key in enabling us to make a successful transition from a fixed to a market-based exchange rate. And first amongst these, Bilal, was an appropriate backdrop of macroeconomic policy measures. What were these? I spoke to you first about the current account adjustment. Before we started the transition to a market-based exchange rate, the current account deficit had already halved from an average of 2 billion per month to 1 billion per month. And this was key because we wanted the market to see that a lot of the adjustment on the current account has already taken place. Some countries start their exchange rate transition when the current account deficit is still widening. And for them, it's a lot harder. So first was demonstrated progress on an improvement on the current account. Second key backdrop was the announcement by the government that they would stop borrowing from the central bank. And in the previous fiscal year, the government had borrowed large amounts from the central bank, which is akin to money printing. It causes a rapid expansion in net domestic assets, which for the central bank balance sheet leads to a fall in net foreign assets and is a drain on one's external position. So that announcement by the government was key. Third, we had allowed the exchange rate to depreciate considerably in steps before undertaking the transition, so that when we do communicate that we are in a market-based regime, a lot of what we considered the underlying pent-up excess demand for the dollar, in our view, we thought already had been allowed to be reflected in the exchange rate. And finally, we had to raise interest rates to provide the appropriate background and comfort that in case there's a materialization of risks, the return on rupee denominated assets is attractive enough to limit any such speculation on the part of those who may think that the currency actually is going to go in free fall. So a combination of these four policy measures, I think, one, gave the backdrop. And again, I would say, Bilal, I want to emphasize that this would not have been possible without the support that the policymakers received from our Prime Minister to be able to undertake these difficult measures before the transition to a market-based exchange rate system. But second also was the communication with the FX players. And before we did this transition, we had a key meeting that we organized with the bank presidents and the heads of their treasuries. And in this meeting, we had a very candid conversation with them. And we explained to them, this is before the transition, we explained to them where we were headed, because we thought it's very important that there be good two-way communication between the banks and the central bank. And we explained to them that the regime was changing. Previously, if a bank treasury had a gap at the end of the day, they would come knocking at the door of the state bank and ask that gap to be filled. And the state bank, because it was in a previous regime, would fill that gap, and thereby the exchange rate would not move that much. But it had a perverse impact. The impact it had was that it prevented banks from doing their planning for how they're going to meet their FX needs, because banks both receive inflows through remittances and export proceeds, and they have to make payments on behalf of clients. And a key message that we conveyed in that meeting was that we will need the banks to start doing more planning for their FX outflows and inflows. And what this means is, first of all, to get advanced information from their clients on expected outflows. So banks' treasuries can be prepared as to the payments that are coming. Second, to engage in a dialogue with the exporters and the remitters who previously had complained that they would not get competitive exchange rates from the banks. And we explained to the banks that you have to reach out to your clients who bring inflows as well. Because as we complete this transition, we are not going to be there at the end of the day to fill a gap like the central bank used to do before.
So on that, it's quite an adjustment for corporates in Pakistan, exporters, to suddenly be exposed to FX risk or FX volatility in that way. Do they have the tools to be able to hedge their FX positions? Do they have the skill set even to be able to manage the FX exposures that they had? So one is obviously the banks, but then there's the underlying customers who are now exposed to the FX risk. What's your kind of sense on that side?
It's a chicken and egg problem. Because as long as a central authority is standing at the end of the day to prevent volatility, market participants will not develop the tools to cope with volatility. And it's a bit like how children learn how to bike. Until you take the training wheels off, you're not going to learn how to ride a bike. And when you do take the training wheels off, initially, one may fall off the bike once, twice. And at the beginning, Bilal, we did see the exchange rate move quite a lot within the course of a few days. It is to be expected. But then what you will see, if you plot our exchange rate on a daily basis and you look at how it evolved, it had reached a level at one point about 164, came back down, then it rose back up to around 161. I'm talking about the early days of the transition. And then as the market grew confident in the new system, it steadily appreciated from these levels to about 154 before COVID. And so what I'm trying to illustrate is that people begin to learn to forecast their inflows and outflows better if they recognize and they realize that the market needs to manage itself. And it's not a difficult thing. Most emerging markets with flexible exchange rates do manage themselves. We clearly communicated to the banks that we are still there in case there are disorderly market movements. But we want you to manage inflows and outflows yourselves. And that communication, the bigger point that I want to make is that communication, which was in our part, one of the key ingredients for making a successful transition, And that meeting at the highest level was followed up with technical level meetings between our FX people with the heads of treasuries of banks to have two-way communication, for us to explain how we saw the new market functioning, and for us to also hear from the treasurers what concerns they might be experiencing. So just to summarize, Bilal, there were two key factors which we thought helped us to make this transition. One was the appropriate macro policy backdrop, the fact that the current account deficit had come down, the fact that the government had announced it would not borrow from the central bank, the fact that our interest rates were at levels which would give some comfort to those who have rupee exposure, and the fact that the exchange rate, in our view, had been allowed to reflect a lot of the pent-up demand that we had thought existed on the dollar. So one was the key macroeconomic policy backdrop, and the other was the communication with the banks to have this two-way channel open.
Yeah. And so if we switch now to inflation, and if we look at the numbers in Pakistan, there was a big run up in inflation towards the end of last year, beginning of this year, where inflation, I think, reached around 14-15%. It has since fallen. How are you viewing the inflation trends and how the state bank can more adequately target inflation?
So as we transitioned from a fixed exchange rate to a market-based exchange rate, one of the key issues that we struggled with was what would be the new nominal anchor if it was not the exchange rate as it had been before. For us, it had to be expected inflation. And that in turn, Bilal, is in heavy part a function of communication. How well does a central bank communicate what is the new nominal anchor, and how it makes interest rate decisions, and how it looks at expected inflation? So we very consciously began to reorient our monetary policy statements. And if you compare them before and after the exchange rate transition, you will see a very noticeable emphasis on expected inflation. And we published in earlier part of the fiscal year that we expected inflation to average 11 to 12% for the fiscal year. We said this early on, and it was on our part one of the actions we took to try to anchor inflationary expectations. Now, we had a challenge when inflation began to rise, and as you mentioned, the year-on-year rate rose to 14+% at one stage, and people began to wonder whether the 11 to 12 range that we had announced was still credible or not. But we were fairly confident that the causes behind those increases were temporary due to supply disruptions in the food supply chain. And we ended the year with average inflation of 10.7%, so very close to the 11 to 12. The second way in which we measured our progress was that we started a regular survey of inflation forecasters. And we regularly looked at the distribution of inflation forecast across the survey responders. And we noticed over time, after we had started the transition and after we were consciously trying to invest in communication about expected inflation, we noticed that that distribution of forecast began to converge. It began to narrow, and it began to converge to the 11 to 12% range. And so that for us was a measure to judge how effective we were being in our communication to keep inflation expectations anchored. Third, what we did was we started a tradition that after every monetary policy meeting, we began to hold a closed door meeting with market analysts. These are the research heads from the different banks as well as brokerages in Pakistan. We would give them a presentation. There would be no media here. And we would share with them what considerations led the MPC to decide what it decided. And in those presentations, we used to have a heavy focus on how we are forecasting inflation, what we expect it to be, how we are seeing the recent shocks to inflation. So to answer your question, for us, the key anchor was to bring a focus on expected inflation. And to do that, a key focus was to strengthen our communication. We have also started making a lot more use of social media and particularly Twitter. And I would urge your listeners, any of who follow Pakistan, to follow the State Bank of Pakistan on Twitter, and we use that channel first and foremost now to communicate. Whenever we put out a press release, whenever we put anything out, we have been using a lot more of that channel than we ever did before in our history.
Yeah, and we'll add the Twitter handle in our show notes as well. Just one question on the surveys. Presumably you're surveying professional forecasters. Have you considered surveying households and consumers more broadly?
We can definitely consider doing that, but right now we are focused on the professional forecasters. And the reason we are focusing on that is that they in turn set the expectations of the broader business community. Because as you can imagine, the business community may have some mistrust of any public institution. And historically, Pakistan has had a history where sometimes those who are skeptical in the private sector may have good reason. We are trying to change that. We are trying to build trust. And the first step in that is the most active students of the central bank communication, which is the analysts and the brokerages, because the business community reads them very carefully. And we thought that that would be an effective way. Just to give you a simple example, a large business manufacturer would use the information from a private forecaster to decide how much wage growth they're going to give to their. And if they follow that analyst, and in turn, if that analyst finds our forecast credible, then we have been successful in anchoring inflation expectations, avoiding price wage spirals, and generally being more effective on communication.
And one, I suppose, almost more philosophical question is in emerging markets, and this also affects advanced economies as well, there's a question of how monetary policy transmits to all segments of the economy. And since the global financial crisis in general, there's been a bigger focus on the distribution of growth and income inequality and so on. So in the case of Pakistan, do you think that when there are easings by the state bank, does it transmit down to all segments of the economy? Or do you need to use other forms of policy to try to reach corners of the economy that may not be as financialized as other parts?
Let me answer this question first by illustrating what happened during COVID, because if there was any instance where one had to figure out how to give effective stimulus, it was COVID. And the lesson we have learned is that when there are situations like COVID, you need to focus both on quantities as well as on interest rates. You need to focus on flows as well as interest rates. We reduced interest rates in Pakistan by 625 basis points, which is, I think, the largest cut in emerging markets aside from Argentina. But Argentina, as you know, was dealing with the sovereign debt crisis and had extremely high interest rates. And despite this big reduction in interest rates, a equally important, if not more important, part of our stimulus package was the quantity or the flow or the credit measures we undertook. First, we introduced a presumptive extension in principal payments of banks' borrowers to banks. And what this meant was that it provided a 1-year breather to a borrower in terms of the impact on the cash flow of the borrower. When something like COVID hits, as you can imagine, banks also become very conservative and they may want to stop lending actually, and they may not want to roll over the loans that they have outstanding. So we sat down with the banks and we explained to them that this has to be their decision because we do not want to negatively affect the credit culture. But at the same time, if collectively banks become very conservative and they begin to not roll over loans, even from solvent clients which are facing illiquidity, their actions will lead to liquidity problems becoming solvency problems. The banks cooperated with us and we issued a joint press release between the Banks Association and ourselves about this scheme. And this presumptive 1-year extension, banks still had to make the decision. And there were cases where they declined the extension, but there were few cases. And those were cases where a client may already be having problems. And if a client was already having problems, then it doesn't make that much sense to prolong what needs to be dealt with. And that extension in terms of the impact on household and business cash flows was tremendous in the hundreds of billions of rupees. Together with that, we extended the period from 90 to 180 days, during which a client may restructure its loan. So the 1 year extension was only on principal. Interest still had to be paid. But for certain clients who also needed a restructuring of the interest, we doubled the period from 90 to 180 days in which a bank and the borrower can try to reach agreement on the new terms or the new repayment profile. And if they reached agreement in that period, the classification and the provisioning would be on the basis of the new contract. And that gave an incentive to banks to proactively engage in such conversations, because once a loan is classified and the bank has taken a provision, its interest then to achieve a rescheduling diminishes because it has already been taken out of their income statement. So that incentive that the classification provisioning would be done on the basis of the new contract also led to a lot of restructurings. And all of these figures are on our website. And I would also ask your listeners that if they are interested in how these measures are impacting the business community, on our very homepage, right at the top, is a banner on countering COVID. And if you click on that, you will get a weekly update on the take up in this scheme as well as other schemes. Another liquidity-based scheme that we introduced was a concessional credit facility for payroll financing. And the way this worked, Bilal, was that we provided credit to a bank and we told the bank to reach out to its clients and tell them that if any borrower committed to not laying off its workers for 3 months, that's how it was introduced at the beginning, they would be able to borrow from the bank at 3% interest rate. And while the policy rate right now is 7%, the market rate would be close to 10. So that was a significantly concessional rate of interest. And this gave an incentive to the borrower to not lay off workers because they would borrow at 3%. And we have recently extended this for another 3 months because we have seen that the stress is still there. And what this allowed us to do was to quickly pump in this liquidity and prevent layoffs. These two examples of liquidity measures, Bilal, would not have been possible just with interest rate adjustments. And so I wanted to answer your question about the fact that in dealing with something like COVID, you need to focus both on liquidity as well as interest rate measures.
And the take-up of these programs, have they been quite good? Say, for example, this concessionary payroll discount on the loans.
If you look at the impact on business and household cash flows in aggregate, the impact of all of these measures, the interest rate reduction, the principal extension, the loan restructurings, the payroll financing, a couple of other schemes, has been about 3% of GDP. So there's 3% of GDP of additional net savings, net reduction in outflows of the cash flows of businesses and households. And the details on all of these measures are on our website. We are even publishing the number of requests for financing under these schemes and the amounts that are being approved by banks. Further, in the interest of transparency, we are publishing bank level information on which are the banks that are most proactive in providing such stimulus and relief and which are least proactive, to try to use some moral suasion and transparency to encourage those banks who are not as active to consider being more active in providing this temporary support.
Is there much communication with your counterparts in other countries around the world around these sorts of emergency measures? I guess it was a very rapidly changing situation, but is there much communication between central bank governors around policies that are working in their countries that you could adopt in Pakistan, say?
I have had informal communication. And as you can imagine, in situations like these, the informal networks that you have are the most reliable. And I have had bilateral conversations with other governors, and I have spoken to them about how they were dealing with these challenges, what they were finding to be effective. And that probably was the biggest source of high quality information that I could get. Only one governor can appreciate the pain, the constraints, the challenges of another governor, especially when you're dealing with such a powerful external shock where all kinds of things are happening simultaneously and you have all kinds of pressures on you.
And if we zoom out a bit and think about the structural reforms that Pakistan needs, it's been said for many, many years now, if not decades, that there's certain structural changes that Pakistan needs. One basic one has been expanding the tax base, which is associated with tax collection and so on. Another has been boosting exports. Then there's issues around social security and benefits and so on. How does the state bank figure into these structural reforms? Of course, many of these aren't really directly the remit of the central bank. It rather would come under other ministries. But obviously, at the same time, the state bank does have an influence here. How do you position the state bank within this reform program?
So we have a fairly clear sense of the architecture of structural reforms. There are some which are outside the domain of the central bank, where we see our role as supportive. Wherever the government is, say, trying to do tax reform, they have our full cooperation. Wherever the government is trying to do reforms on the power sector, they have our full cooperation. So we provide a supportive role in areas outside the domain of the central bank, but we focus our energies on those areas within the domain of the central bank. And we start off with what I mentioned about reserves, about the state of the financial sector. And this leads us to focus on three key priorities for the central bank. The first is exports. And it is a key priority for us because exports will translate into higher reserves. This is the highest quality source of an increase in reserves. And to that purpose, the exchange rate adjustment has helped. In addition, we have refinancing schemes. By refinancing schemes, I mean schemes which provide where we lend to a bank and the bank lends to the client, which support exporters and primarily through concessional credit. And these have been found to increase the amount of exports that we have. So first structural priority is exports. Second is inclusion, I mean financial inclusion. And in Pakistan, we have a credit to GDP ratio, which is considerably lower than in peers. And particularly, if you look at the distribution of that credit, it's very concentrated in the large players. And a key part of our focus is to get the credit out to SMEs, to women, and in sectors which have typically been underserved, such as housing and agriculture. And there is ample economic evidence about how greater financial development leads to greater economic development and poverty reduction. So that's a second key structural priority for us. And the third is promotion of savings in the country. And as I had mentioned earlier, having a low savings rate and having a constraint thereby on investment has been a key impediment for our growth. And having a low savings rate has led to large current account deficits and repeated pressures on the exchange rate and reserves. And I think through the emphasis on inclusion and through other areas, we want to continue to focus on that as a structural reform priority for the central bank.
Thank you, Governor, for that. Now, we've spent the bulk of this conversation so far on Pakistan. Now, I know that you have extensive experience internationally as well, and you have views on emerging markets elsewhere and policy responses and so on. So it'll be useful to perhaps get your view on how do you think global policymakers and multilateral organizations responded to COVID compared to what the response was like around the global financial crisis?
Thank you, Bilal. So, as you noted, before joining the State Bank of Pakistan, I had spent 18 years at the IMF and at a part which was very central to designing the policy response to the global financial crisis after Lehman. And I think the first thing that has to be said is that the international financial institutions moved quickly to support emerging markets. And particularly, I think one needs to give credit to the heads of the IMF and the World Bank. The IMF in particular has moved very quickly to provide support through the rapid financing instrument. Pakistan has been one of the beneficiaries. The World Bank also has stepped up its lending, and so has the ADB as well as the AIIB. At least I am recounting the ones that have been active in Pakistan. Second, I think one has to give credit to the G20 and its Saudi leadership, and in partnership with the leadership at the IMF and the World Bank have provided liquidity support from bilateral official creditors to emerging markets. And that is a significant factor that is going to help the countries as well. And I think third, the IMF, the World Bank continue to discuss what more changes they can do in their policy frameworks to continue to support emerging markets. And this is welcome. So for instance, the IMF has recently said that the normal country access limits that it has, in the case of the rapid financing instrument, they would give flexibility on that, which essentially means that countries will be able to borrow more from the rapid financing instrument, which is welcome. At the same time, I think if you look at the response to the global financial crisis, there were some very significant new instruments that came about back then. And one such instrument was the flexible credit line, which is for the first time in the history of the IMF, was a credit line where you pre-qualified to get credit from the IMF, and you did not have to fulfill any condition to draw down. It's a bit like your credit history enabling you to get a platinum credit card, which you can use anytime. All you need to do is make a phone call. And you would have seen that Mexico, Poland, Colombia all took advantage of the flexible credit line back in the midst of the global financial crisis. And the IMF was rapidly able to disburse tens of billions of dollars in that. And it was the first time that the idea of conditionality had changed in this fundamental way, that it was not the case that some conditions had to be met in the form of a review, and then there would be the provision of credit. I think this time around, all the efforts are welcome, but there hasn't been a new instrument or a change of the magnitude of the flexible credit line that was introduced back then. Second, I would point out that the G20 really came together last time around in a very, very effective, proactive manner. The G20 is also doing that now, but many of the observers of the G20 have pointed out that it's not the same as it was before. And I think the G20 right now is perfectly positioned to use that forum more to bring the international financial community together to consider new, ambitious, and bold measures. The third point that I would want to make is that the international financial community has so far given liquidity relief to countries. Debt initiative, the multilateral debt initiative, has been primarily a treatment of the flows of debt coming due, which in a NPV neutral manner have been rescheduled. And I worked extensively in the part of an IMF that dealt with debt issues as the chief of the debt policy division. And one lesson that I took away was that, and now I'm talking purely from the global financial architecture perspective, I'm not talking in the Pakistan context. So I wouldn't want any of these comments to be taken in the Pakistan context. But when I look at the landscape of developing countries and emerging markets, I see that there will be a need at some point in some countries, and again, I'm not referring to Pakistan here, where there may need to be a consideration of debt reduction, not just debt rescheduling, but debt reduction. And my experience of debt treatments is that the hardest issue is the burden sharing between the private and the public sector. Historically, you will see in terms of debt reductions that the private sector is essentially forced to take a debt reduction because the official sector determines the envelope of resources available to a country to service its obligations. The official sector finds it very difficult to give a debt reduction. And a case in point is I also used to head the IMF delegation to the Paris Club for 4 years. And the Paris Club is the forum where bilateral official debt treatments are given. And there's a very famous case of Poland when back in the day when the curtain was being lifted and Eastern Europe was moving out of the Soviet bloc and a number of countries were being given debt treatments. If you look at the case of Poland, Poland got several flow treatments from the Paris Club, several reschedulings. And each rescheduling, Paris Club creditors thought would be enough to address Poland's problems, but they were not. And in the end, it took, I think, nearly 10 years for there to be a recognition on the part of official creditors that a debt reduction had to be given. And so those several reschedulings were eventually followed by a stock treatment by a debt reduction. And from the day that significant debt reduction was given to Poland, it was several tens of percent of GDP, Poland has never ever gone back to the Paris Club. And so what I'm trying to say is that it is hard and it takes time in the official sector to recognize that there may be a need for a debt reduction in certain cases. Similarly, if you may remember, Bilal, an example of multilateral debt relief is the HIPC, the Heavily Indebted Poor Countries Initiative. But HIPC itself was preceded by the MDRI, and HIPC itself was preceded by several attempts to do reschedulings. And so I think that it may be helpful for the international community to think about what are the cases in which they think, and now I'm talking from the official sector's perspective, that the official sector may need to provide some debt reduction. And if so, how would one want to go about it? And it would be helpful to recognize that one of the key lessons from history is that there are tremendous incentives to delay that kind of a decision. And such delays essentially prolong the hardship that the borrowing country faces. So that is the key lesson, in my view, from the experience that multilateral institutions and bilateral creditors have had with debt stress in the past. And again, none of this is in the context of Pakistan, but is a more general statement about the international financial architecture.
And I suppose the advanced economies have an incentive to ensure that emerging markets as a whole is on a sustainable path. It's a big source of economic growth and trade partnership between the two blocks, so to speak. What combination of organizations would be the best to lead such an initiative? Would this be IMF-led? Would it be G20-led? Would it be the US, European Union? Which of these bodies would be best placed to kind of orchestrate such a process?
I think the IMF, the World Bank, and the G20, they are already working in a coordinated manner. They already have, well-established channels of communication. They in turn also work with the Paris Club. Paris Club faces a challenge that its membership now is not very representative of the major bilateral lending taking place in the world, because one of the biggest creditors, bilateral creditors, is China, and China is not a member of the Paris Club. And therefore, the IMF, the World Bank, the G20, working with Paris Club and other big bilateral official creditors is, I think, the right forum to take these things forward.
We've had a very extensive conversation, and before we wrap up, I just wanted to check, have we missed anything that you wanted to share?
Not really, Bilal. I will say that I think for any policymaker, particularly a policymaker in emerging market, particularly a policymaker in a vulnerable emerging market, I think this is an experience of a lifetime. And in the context of Pakistan, I want to end by saying what I said towards the beginning, that I am quite confident that the worst of the financial turmoil is behind us, and that we are going to resume the path that we had before COVID to decidedly address the current account and the fiscal imbalance problems that led us to repeatedly ask for assistance.
That's excellent. So once again, thank you very much, Governor. That was an excellent conversation, and good luck with all your many challenges that you have going forward.
Thank you. And thank you to all your listeners.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.